Good afternoon, and thank you for joining this Yellowstone Advisory webinar. Today's company presenting is Capita, and we're delighted to have with us Adolfo Hernandez, the CEO, and Pablo Andres, the CFO, who will give an update on performance following the publication of the half-year 25 results. I'd now like to hand over to Adolfo to start today's presentation.
Okay, thanks, Alex. Good afternoon, everyone. Good to have the opportunity to come back and do another one of these update sessions. And the last one we did was sort of end of March, early in the year, and a lot has happened in terms of continuing to execute on the transformation that was much needed, but very exciting transformation of Capita into that better company. I think you've heard me talk about this before. We are very comfortable with what Capita does. I think the amount of service we provide in different parts of the public sector, what we do on behalf of consumers, what we do on behalf of brands in Western Europe, it's really good. So there has never been a question on the what the company does. It was more on the how the company was doing it. And eventually, how do we get the company to a point where it can generate the same social value, but also generating cashback profits for the first time in a long, long time. And just a year and a month ago, 2 months ago, I stood and I just said, okay, the way we're going to do this is we're going to use 4 main vectors of intervention. One vector was better technology, then better efficiencies and better delivery, and ultimately building a better company. And I will go through each of them, and I think you might have seen this theme before, so you'll find some common themes, but just a lot more execution and more solid progress in each of the areas. Then what we've gone now is going into a further level of detail, and now we've created 6 pillars of execution, which is the ones that you see there in the gray in the middle, which is how we're going now about delivering that transformation, all the way from the cost transformation that we're reporting all the way down to building new values and a high-performance organization, revisiting technology foundation, the operating model, the sales effectiveness to deliver accelerated growth, as we have started to experiment in this period with both growth of TCV and a number of other go-to-market metrics. And underneath that, we needed to rewire the culture of the company very much to be more agile, more sort of 21st century, more on the cloud, more innovative, and one that really works from the customer backwards and identify what the customer needs. And that's the starting point from absolutely everything. And I want that we need to collaborate a lot better. So the rewiring of Capita right now is not a one single silver bullet. We're having to touch absolutely everything in the organization because, again, this is about building a sustainable platform that can take advantage of the opportunities that are going to be huge over the next few years. And we're starting to see the beginning of it and do that in a way where we can get profitable growth, but also cash back profits, which is really important. So we've been on that journey. That's been the vision. If I go to the next slide, you see there the okay. Eventually, we'll get to see the next slide there. There we go. The summary of the first half. So we're trying to sort of capture some of the key themes there, and that we're going to cover today across the 4 vectors. On technology, obviously, the growth of the pipeline, the growth of the solutions that are there in market. And I think if you've listened to a prior presentation or you've read some of the document, you see now AI at work producing operational benefits and providing a much better solution set to our customers. On the efficiencies, remember we first started to talk about efficiencies just before I joined. It was about 40 million, which we increased to then it was 60, then it went to 160, then it's 250. We achieved 190 at the end of the half, 205 of that by the end of July, and we are well on track to go and deliver that. And this is a very important point because we were just effectively running a much higher cost structure than the company was capable of bearing. Delivery, very important on a couple of areas. So strengthen the book to bill on both sides, and TCV growing as a group 17%. Certain parts of the organization growing much faster than that, into the 50% plus. And most importantly, there is no mention to rep projects or new difficult projects that have been created, and that's just a sort of a result of the great work and the much more controlled execution that we put into our customer projects. Company, we've seen a steady engagement level. Nothing really to talk about there, but we're starting to see an improvement on Net Promoter Score from our colleagues and employees, and that's kind of important in a time where we have been changing so much how we operate, and there's been job losses, there's been reductions, reorganizations, retraining, repurposing. So in that context, to see an increase of employees sort of recommending that, it's very telling. Now, this is supposed to just be a quick flyover of what you're going to hear. Those are sort of the more salient points. We remain committed to our guidance and to exit this year being free cash flow positive and getting into that sort of change of momentum. There's a lot of different moving pieces. We've got a business already performing very well in the high end or outside the high end range of our guidance. That is the public sector business with operating margins of 8%, TCV growing at 53%, revenue growing probably the fastest it's ever been. But then we've got some other businesses that continue to have challenges. But here, we have to work one business at a time or two businesses at a time. And I think when you just sort of look underneath the bonnet, you're going to see there's some parts of Capita that are already well retuned for the future, and others that still need a little bit of work, which is not bad from where we stand. It's been really difficult and challenging 18 months, but really excited about what's going. So I'm going to ask Pablo to quickly run us through some of the numbers, and I'll come back and do some of the operational background progress, and then we can open up for Q&A. Pablo?
Thank you, Adolfo, and good afternoon to everyone. Great to be here with you. Conscious you will have seen the slides and probably the webcast that we did with the half-year results. So I'm going to just canter through the key messages from the main slides to allow sufficient time for Q&A later. On the financial highlights summary page, probably two key things to talk about was revenue, where we had very strong revenue in the public business area, which was offset by volume decline and shift to offshore centers that we're having in the contact center business and we're working through. On operating margin, we do have a mix yet again here of good progress that we're making in operating margins, where the public and the pensions business are delivering very strong margins, but there is more work to do into the second half to offset the impact of the losses of volumes and volume reductions in the contact center. And probably the other key message to me is on cash flow. We ended up on a free cash flow of 26 million outflow. Of that 26 million outflow, 21.5 million was the cost to deliver the part of the savings we have delivered so far on the 250 million target. That is 50% lower cash outflow than next year. And this is what is giving us the increased confidence that by the end of the year, we will finish delivering the 250 million savings, and we will be delivering positive cash flows from the end of this year. On that, you can see below the progress on each of the divisions on the work that we're doing. Public service margin increase, progressing. Contact center, more work to do. Pension solutions is a matter of timing. We expect the margins to continue improving in the second half. Regulated is the business we're trying to exit, etc. So if we go to the next slide, on the next slide, basically we touch on Capita Public Service, 3.8% revenue growth. Speaking with Adolfo, it's like the highest we've seen, I think, other than in 2021, when I think we won a very large contract. I asked Copilot to find when was the last time we had grown this much. I mean, it got back to 2015 and said, haven't found, do you want to go into the archive? So I do think this revenue growth has been good performance. And I think that our strategy on focus on mid-sized deals, whilst we're still hunting selectively the large elephants, is starting to prove it works. On margin, we made really good progress, and we were able to offset the impact of cessation of contracts and indexation and inflation with the cost savings. And that allowed in order for the growth and the profit from growth to flow into our bottom line. Cash conversion remained consistent with the way this business is doing. And this delivered overall, as for public service, what I believe was a good H1 performance. In terms of the next slide, in contact centers, we have more to do. In contact centers, we highlighted at the end of the second half a decline in volumes in the telecoms vertical that we're seeing the annualization in the first half, but we still have net wins and losses. We have a trend of offshoring from our customers into our global delivery centers in India and South Africa, and the impact of indexation and NI. That was partly offset with cost savings, but probably the biggest area where we have more cost savings to deliver in the second half is in the contact centers. Probably I wish we had been faster in the contact centers with cost savings. We're executing at pace. We've got a good program, and we're confident by the end of the year, we will deliver the cost savings we need to deliver and we have committed to. So that is the story on the contact centers. I think it's a work in progress. It's a fast evolving environment. And I just want to remind you all that slides 49 and 50 to me, even though at the back of the presentation, are actually the proof points on we are doing everything that our competitors are doing. We are taking the right actions. We are offshoring, albeit 5 years late to many of them. We are now doing it, and we are putting in place. There is a list of 10 technology solutions that are either live or on proof of concept to go live that are perfectly competitive with the industry. And we're seeing that in specific contracts where we have deployed it. We now need to, we know the medicine, we now need to go systematically through all of our portfolio of contracts, adjusting one by one and delivering all of that. Pension solution is a good business. It's a strong business. It's delivering 11% margins, and we're expecting to continue improving. In the first half, we had some timing of revenues that is going to be recovered in the second half, where we have a very strong pipeline. And we had lower profits from lower interest rates, which again will be offset in the second half through additional growth and additional cost savings. And we expect to continue making good progress in this business. Cash conversion was quite strong at the year end. It was around 100%. On the first half, cash conversion was lower as we are investing on the mobilization and implementation costs for the digital investment on the civil service pension scheme. Again, when looking at this business, a very attractive business, our digital solutions platform that we are working on to be delivered by the end of the year is a game changer. And we have very strong support from our customers. And we feel pretty confident that this business is going to continue, is already delivering and is going to continue evolving in the positive way going forward. And then we go to the regulated business. We highlighted back in 2024, the Capital Markets Day, this is the business we're seeking to exit. We are making our way through it. We are handing back contracts after contract. And in February, and we announced it in March, we signed the deal with a penultimate customer to exit services and to hand them back. And that's what we're doing during the year. We are on to the negotiations with the last customer in the regulated services. It's the last but not least, I say, because with that customer, what we say is we will be delivering 20 million of cash outflows year after year unless we find an exit with them. It is one of our highest priorities for this year, and we are remaining engaged with the customer, looking for a solution that suits both parties. Other than that, there's nothing else I can say, but it remains one of our priorities for this year, and we're going to continue working hard on it in the second half. Moving on to the next one, to the cash flow. During the first half, cash conversion was good, was 70%. I try not to be absolutely obsessed about cash conversion because in a business with 2.5 billion turnover, the amount of cash that gets collected every day is very significant. And I think I did the analogy in the year-end results where I said, well, actually in the last 4 days at the year-end, we had collected 50 million. So that could create a massive swing. And the same applies to half-year results. In the last 2 or 3 days, we collected 46 million. What I have to look is standing back saying, did I land where we think it landed? Did we land in a balanced position? And my view is, yes, we landed exactly where I thought we would. It's been a balanced position. It's been a good outcome. And we continue now working into the second half. So then what you can see below is the cost reduction program that we're investing to deliver those 250 million savings by the end of the year. Going into the next slide, what we have is the remaining of the cash flow, where after CapEx, interest, that had some timing of withholding taxes in that line, and capital lease payments that continue reducing by 10% year after year as we go through all of the leases and try to optimize our position. We ended up with those free cash flows, excluding business exit, of 26 million outflows, of which yet again, the majority of them are the cost out program that we are executing. Other than that, I tried at the bottom to provide a little bit more clarity so that I don't have to use my hands explaining how this works, how our net debt is 412. That includes the lease liabilities, but I don't think we had been good enough at explaining that actually part of those leases that we were not using were sublet and generated 94 million of receivables. So hopefully the table below now makes it clear that yes, the official net debt with financial institutions is 412, but if you consider also the leases receivable, our net position is 319 million of debt. Other than that, I will move into the guidance. On the guidance for the group, we reiterated basically guidance on everything in terms of revenue, margin, free cash flow, net debt. However, having seen the trends in the first half, we saw a stronger than expected half in public service in revenue growth. And public service is 62% of the revenue of the group now. So it's actually quite significant compared to the contact center. So we upgraded our guidance from low single digit to mid single digit for the public service. In the contact center, having seen the effects of the annualization, the revenue, the losses, and the offshoring, we reduced our guidance to mid-teen revenue reduction for the year. And as I say, because of the different sizes now, contact center is only 24% of the group, then our total guidance on revenue has remained the same. And then in relation to the rest of the guidance, yet again, we expect 45 to 65 million of cash outflows by the end of 2025, of which the vast majority, 55 million outflows, are the expected cost to deliver the full cost reduction program, and therefore the additional 90 million of savings in year that we will deliver to go into next year. And that is what gives us, therefore, a level of confidence where we say, yeah, with that, free cash flow positive from the end of 2025. With this, I'll hand back to Adolfo for you to continue.
Okay, thank you, Pablo. Yeah, it's good run through of where we are. Let's see. So I'm just going to spend a few minutes on a couple of things, operational and strategic. So I think this is really important background to understand. If we had intended just to quickly transform the company and so that it could just do this sort of 3 to 5% margin and not worrying about what was going to happen over the medium and the long term, that's one trajectory. One of the reasons why I took this role is because I firmly believe that the traditional BPO market, where our company and a number of other companies have played for the last 40 years, was going to be fundamentally transformed. And with transformation came danger, but with transformation also came opportunity. So I joined the company and I took the challenge to go and retool the company so that we could take advantage about this emergence, and this was 18 months ago, of what appeared to be an AI-powered business process outsourcing market that was emerging. So when 18 months ago, that was sort of, it looked like it was happening. Now we see that that's already 10 billion across Western Europe. So it's actually grown quite a bit. A lot of it it's IT related and very closely. But I think the important thing is if you sort of play through into 2027, you're going to see that that 10 billion becomes 30 billion. And you're also going to see a shrinkage of the very traditional, very manual services. So for us to be relevant, not in 2025 or 26, but to be relevant and successful and take advantage of that growth, we've got to position ourselves firmly in our ability to deliver AI-enabled business process outsourcing. It is not a choice. And I know some of you wish that it was different, but the market is going where the market is going. I can't beat somebody else at playing their game. I have to beat others in a new game. And that's what we're trying to do. So the good news is that the thesis is proving right. So our market has gone from nothing to 10 billion in the space of 2 years. And now in the space of the next 3 years, it's going to go from 10 to 30 billion, right? It's going to, some of it is going to migrate. So services that were not AI enabled now will be done with AI. So there's a migration from sort of the dark navy into sort of this orange pink. But there is a number of brand new services as well that are going to be happening. So we are seeing demand. We're seeing demand from the public sector. We're seeing demand in the private sector, probably bigger in the private sector today. A lot more is about efficiency in the public sector. A lot more is about dealing with frontline productivity, dealing with backlogs in public services and delivering better services. But it is there. And customers out there, whether it's governments, institutions, or other private organizations, they need help with three things. They need help with skills, they need help with the data, and they need help making sense of all the possible solutions, all the technology that it's being invested and invented daily in this space. What makes sense for them in the marketplace? So this is that journey, that's opportunity that makes the future of Capita much brighter than just have we done some cost cutting to be doing the same thing in the same way that we did it for the last decade. So the next slide intends to give you an update on the manage for value. Remember, we have 3 buckets. We had a bucket which was, okay, these are things that we're doing well. These are start positions. We sell well, we sell often, we win well, we make good money, and we deliver well. Great, so we're doing well of those. You've got the middle bucket that says these are things that we want to be in. They're good markets, but we're not doing them fully the right way. And we're working through that. But it's, as Pablo said, the single biggest outstanding item at the moment is the call center, where we're doing now the right things, but we just need now the time and the progress until these things show in the P&L. And then there was the problematic manage for value, where we needed to do a number of things. So this is taking a disproportional amount of time from management because these are problems that were dragging the business down, as much as or sometimes more than the call center. So we dealt with standalone software. Now the mortgages was the last piece, and that's just about to go out. So it's been announced, so we're just looking for completion. Networks was something that was a challenge because we had a very legacy-oriented business, stuck with a lot of hardware, equipment, all routers, and installed in many councils, universities, and things like that. That needed a way forward. We managed to get a solution with AWS to move all that business to the cloud and be able to now provide elastic networking services to the institutions and our customers without having to incur big capex or big deferred income type projects. Similar on IT managed services, something that we do for a lot of our customers who would want us to be managing their estate, and traditionally it was all manual and it was very legacy. We've done the first part. We've moved our own systems management and our own colleagues onto ServiceNow very successfully. This is what we call Client Zero. We've done it, we've built the capability, and now we're starting to migrate our customers onto this new platform. And that will give us, obviously, the opportunity to make more revenue. Most importantly, it's the first time that we're going to be able to make money in that particular segment. And then in closed book life and pension, as you know, we had to work down a list of 10 evergreen contracts and sort of agree the exits and working through the exits. We've done 9. We got one more customer. We are working with them at the moment and trying to find an orderly, professional, and well-regulated exit, and we don't have anything to report as of yet, only that it continues to be a high priority item for the management team. If we go to the next slide, I've been asked to sort of explain this agentic thing and AI and why is this relevant for Capita and why is this sort of all new. So I was just trying to oversimplify it here by saying there is sort of 3 buckets of new technologies that are going to be very relevant to our customers already. So you've got predictive AI, that's sort of when you look at existing data that you have, just sort of predicting what's likely to happen. So, and it allows you to do some next best offer. So it's effectively using the data to tell you what the data is saying, but they're doing it in a way that is agile. Again, this is something that has been in market for a long time. Just the sophistication of tools now makes it very, very easy. An example of that is call site. So it's something that we do now where we don't need to parse manually 5% of our calls to listen to them and have humans listening to them. Now we get real-time insight from 100% of the calls because the AI is doing that work, looking at what's happening, and then it's telling us what is likely going to be happening next as a result of interpreting all the data and all the transcripts in real time. Generative AI is effectively generating code or language or responses on the back of existing code, language, or responses. So you effectively train something to behave like a bot, but the bot is not making things up. If you've done it properly, it should just be replaying scenarios that it's being trained for. And we're already using it both with the British Army. We're using it in call centers. We're using it across the board. So it's about just capturing what good looks like, capturing all the interaction, capturing all the knowledge bases, putting it into an entity, train it, and then get that entity to be the one that interfaces with a predictable outcome. And then there's the more autonomous version of it, where you not only you give content, but you also give precise instructions to the bot, which now we call an agent. So in defined circumstances under defined instructions, the bot will be doing something on your behalf. And again, this is something that, this is not Capita just having a pipe dream. This is, some of the world's largest and most successful companies are investing everything they've got into getting into this space because they see the real possibility. And for us, it's huge. It's huge because it gives us the ability to not only orchestrate now people, as we have been doing with tens of thousands of people working in contracts, but orchestrate our humans, but also orchestrate agents and orchestrate them both together and get efficiencies and a much better service. So what would effectively give us is the components that we don't have to build, we don't have to finance, right? It's something that it's already happening somewhere else in the market. It gives us the chance for us to leverage our expertise in the process, and all we have to do is map it to what's possible on those AI propositions. So very excited that this is happening. And then on the next slide, I think it sort of brings that somewhat to life by showing you that what we do, that sometimes is good to remind. Our contracts, when we win a contract, they tend to be different activities, right? So everything that we do in the public sector will have a stronger component in middle and back office services, connections, disconnections, bill payments, medical records. So there is a heavy middle and back office activity with some front office interfacing into citizens. Right? In Capita experience, so in the call centers and in pensions, is mostly about interfacing with the end customer with a very thin veneer of some light middle and back office things. So the investment today that we're putting in, is trying to solve for those 2 use cases in the 2 divisions. And what's probably unique about us is that we've made a strategic decision that we will not let these capabilities loose on their own. we will always have a human in the loop, a human that will make the ultimate decision, a human that will make sure that the decision is ethical, a human that will arbitrate when you've got multiple choices, what's the one that we can do, but a human that will be much faster, much more productive, because he will have all of these agents working for that human, providing him or her all the information that they will need in real time. So if we can just move on to the next slide, please. Again, you might think this is Adolfo thinking about the future. Yes, I am thinking about the future, but most importantly, this is stuff that we're doing today. And I just sort of wanted to bring it to life on this deck. So in the front office, we talked about the work that we're doing with Agent Suite and Southern Water, how we are seeing improvements on average handling time, which is great. As a happy customer, is less cost. How are we seeing first-time resolution going up? Again, that's less people having to call, less cost dealing with the problem, and a happier customer that gets problem solving on call. You've seen that we're doing some work there for the Department of Work and Pensions to get automatic transcriptions and assessments and validations to look for quality of the engagement with the citizens that are needing this service. So this is stuff that is happening today. Middle office, how do you process different schemes in real time so that you can give local residents the right level of discounts? And to do that, how do you process all the documentation that is required? How you just don't do it with humans? How do you use AI to verify the applicability, to check against fraud, and to really just effectively go from hundreds of humans doing this process to AI doing this process and doing it very, very quickly in real time, and saving TfL money and providing a better service on their behalf. And then back office, we're already doing work with Appian and Bexley and a number of other local authorities who have age debt, for example, in council tax, that they need a smart workflow, they need an intelligent, well-orchestrated process to go about collecting those, and where we will retain a part of that benefit. So it's just to show you that what we might think it's just something that is not there, that is not relevant. It is very much relevant. These ingredients are what are separating good solutions for bad solutions, is what's separating good financials from bad financials. And having this narrative, having these solutions now at play, having those references is at the very core of our increase in TCV, our increase in win rate values, and our increase on a cleaner pipeline. It hasn't happened just because we've changed the go-to-market model, which we have. Is because we have created this more suitable value proposition, where in the past we would have come with a more legacy, human-only solution that wasn't competitive enough. All of this is going to make sense and the next slide. When you see these things, it's a flywheel, right? You would say, okay, how are you going to make money out of this? And trying to capture this in a flywheel, which basically says, because we got that foundational layer of process where we are working, and we've been working over 40 years, that generates data. The data that we have out of our existing engagement allows us to automate. Every time we can automate a part of the service, obviously I'm going to be able to reduce the manual work, so I'm going to get happier customers, happier employees. I'm going to have less attrition, so I'm going to have less cost of attrition, so I'm going to get better productivity and more profit. But most importantly, everything that I automate, I'll be able to create a repeatable offering. And everything that is repeatable, I don't have to pay the innovation cost every single time. I can leverage it. So I'll be getting a much better yield from my innovation. I'll be able to sell more faster, multiple times, and command higher margins. And as you do that, you get a better experience, you get more competitive, and you can win more with automated solutions. You're effectively lowering cost, which then you pass into the bids. Bids are more competitive, you win more. And then because you win more, then you get both more profitable growth and more data. So that's the model, that's the business model that we're working on. We don't have to build on the tech. That is very, very important. It's a significant differentiation from the old Capita. All we are doing is sitting on the top and orchestrating the different services, like I showed you earlier, for the right hyperscaler. There are solutions that Microsoft is bringing, they are second to none. There's opportunities that Salesforce is bringing, or ServiceNow, or AWS. And our value add here is to build, leverage the relationships with the hyperscalers, see what they're building on, see what's coming, get ahead of the curve, innovate with our customers, and then bring the two together. So to that, we've created a number of use cases so 212 use cases where we can do agentic AI inside Capita and on behalf of our customers. And we've got a really busy agenda to continue to bring some more of the innovations that we had in market. So, I think last time I talked about some of the work that we're doing with Salesforce. At this time, we're getting a quote here from what we're doing with Microsoft. And I think just really excited about what we're doing in this space. Next slide, please. As an example, and some, there were some questions, is some of this real? Is this happening? Yes, it is real. It is definitely happening. For those of you who sort of been tracking the company on LinkedIn, you would have seen that Salesforce decided to use most of their keynote event back in June to talk about Capita and what Capita was doing on AI automated recruitment on Agentforce. They gave it a couple of hours. You've got the video link if you need to see the whole session at the bottom of the screen. But fundamentally say, an idea that we had in November, December last year that we've been building for the first few months of this year, that we were able to go limited release at the end of May. And by now we've already got, tens of thousands of candidates engaging with the solution, with a view that this will be 100% of all the applicants going into our solution going forward. It's already making a difference to our recruiters. And our intention is, once this is being bottled and run through completion inside Capita, we will be offering this solution out to market. Next slide, please. So going to efficiencies, we talked about that, right? There's 40, 60, 160, 250, already 205. We've got a run rate roughly of about 10 million per month. So that's why we're comfortable, as Pablo said. The cost to achieve the CTA just being 22 million. We continue to do a lot of work here. Continues to be challenging because we get into a point where it's not about reducing the org. We have to change how people are operating. We have to change the process, or we have to change systems. So to provide not only the saving, but I'm very conscious that getting money out is really easy, but getting money out without the money creeping back in and getting money out without things imploding is the really hard thing to do. And that's what we're doing. So we're just trying to make sure that the money goes once and for all, and that the business has a better improved operating cadence as a result of the efficiency. The next slide talked about some of the areas from delivery where we're seeing improvements. I talked about 17% up in TCV, 53% up in TCV in CPS alone. So we see nearly doubling of the win rate across the opportunities. We're seeing the pipeline growing, and the tech pipeline 4.4 billion. So that's an important. We've also seen improvements on the book to bill. So there is opportunities that we're currently bidding for the second half or early next year. And yeah, we are much more comfortable with where we are from a go-to-market perspective and building the sales effectiveness. In particular, as Pablo said, the progress we've made in medium-sized deals, the progress we've made on new scopes and new pieces of work, getting extensions that have avoided RFP need. But there is more work that we need to do in terms of the call center. And definitely that's the hardest area to look into. If you look at it, public sector, we are on a good tracking. We've got pensions business is on a good tracking. Call center, I think we're doing the right things, but there's more work to do, and we need a little bit more time. And then we just need to finally solve the closed book life and pension standing issues that it's muddling the water and the business performance. Can we do the next slide, please? Yeah, talked about this on Better Company. I don't think we need to cover that anymore. And talked about, yeah. So reiterating the medium-term targets, I think nothing changes. I think Pablo's giving you the color on the sort of the ups and downs that we see going into the second half. It's been a good, solid, busy first half where we're starting to see, as I said, some operational strategic green shoots backed up by financials already in two groups. But then we've got more work to do in the contact center, as I said, manage for value, and then continue to do in terms of the cost savings to get to the 250 and continue to grow the delivery of the sales engine. And I think as we do that, if we continue to build into a better company, refreshing the culture, we will potentially, we will exit the year with a much stronger, much more high performance oriented culture. All right, so let me pause there and then open up for questions.
Great, thank you, Adolfo. Thank you, Pablo. Sounds like public services are doing really well, and there's a bit more work to do in the contact center business, and that AI is key across all areas of business, both now and going forward. And as Adolfo said, we're now going to take questions. We've had quite a few ahead of time, but if you do want to ask a question, please type it in to the Q&A box at the bottom of your screen. And just in the interest of time, I may try and include a couple of questions together. So we're going to start off on a couple of questions on margin that have been sent in. And I'll ask the two questions together, and I think you could probably answer them in one, Pablo. So firstly, a bit surprising to see the decline in margins in the first half, given your ambition is to grow margins. Can you explain what happened here and why you're confident that you can grow margins over time? And then connected to that is, given the projected cost savings of circa 250 million, which represents over 10% of the group's cost base, why have we not seen more progress in the operating margins?
Brilliant. Perfect. Thank you very much. Let's see, contact centers. Contact centers, we have been working hard. We have had strong revenue headwinds, and that is what we're working with the program we've got to deliver further savings to come back to a profitable business and to margin enhancement. We do believe that that business, with the solutions we've got in place, is capable of generating positive margins, even though we have a small scale business on contact centers, probably compared to the largest competitors. We believe that at least the 6 to 8% margins that we've given in the range for the whole group can be delivered also by part of that business and contribute therefore to the overall margin of the group. That is the business that is a little bit behind. We're working further in the offshoring and nearshoring. We're working further in the rollout of technology. Part of that requires data consent and data access from our customers, which is taking a bit longer on occasions than we would like to. But at the end of the day, all of this is what will deliver that business to be profitable and then to build on top of the margin progression we're doing in the rest of the group to help us to get our targets. On the other one, sorry, Alex, you mentioned the... Oh, on mute. Alex, you're on mute, sorry.
Sorry, I was on mute then. The other question was that the 250 million of cost savings is at almost 10% of the cost base. You know, why haven't we seen more progress in improvement there?
Perfect. And thank you very much for that one. And that is why I try to show the bridges to give more clarity, more transparency on where the money is going. We did have some cessation of contracts and revenue headwinds that have an impact of profit, as can be seen on the charts, particularly on slide 11 and 13 with the revenue reductions. And that is what we are working through. So therefore, I wish the 250 could convert straight into revenue, but we had a number of contract losses that were coming from the past, volume reductions that we had to address together with pay increase, etc., and offsetting the NI impact that we had seen. So this was part of the solution. When we prepared for this year, we looked at all of the headwinds and all of the challenges, plus all of the opportunities. And that drove us to the guidance on 250 million savings, which was a balanced position between the headwinds and what we thought can be delivered in the business to still deliver the medium-term guidance we have committed to.
Great, thank you. The next set of questions is on the Ofgem inquiry. Sort of three have come in separately, which are similar. So I'm going to read all those three questions, but you could probably answer it together. So here they go. So how does the board intend to manage the market narrative over the coming months to bridge the disconnect between Capita's fundamental achievements and short seller tactics that are leveraging the Ofgem information vacuum? And the Ofgem inquiry completely derailed the share price, rather like the cybersecurity incident. In footballing terms, isn't there always error in Capita which will always prohibit it from returning to its formal glory? And could the inquiry have been avoided? And the last Ofgem question is, since the Ofgem inquiry into DCC was announced, the share price has imploded, and this inquiry has clearly affected market sentiment towards Capita. Can you comment on the inquiry, and should we be worried about it?
Perfect. So, Adolfo, if you're happy, I'll deal with the facts and you provide the board context and the color. So, in terms of the facts, let's see. Ofgem has been reviewing year after year after year after year the DCC business independently. They've reviewed their cost base. They've considered what costs are allowed and what costs are disallowed, and that was part of the disclosure we had at the year-end these results, where we said that we had a surprising settlement with the for the DCC that took that. So, so that is the relationship with the Ofgem and DCC. DCC, though, is a separate company from us. It is independent, self-regulated, with an independent board of directors that is required by the license conditions. So when we have seen this announcement, what we can say, that announcement was also as much of a surprise to us than to everyone, particularly because of the nature of that business being independent. We know that that business complies with the majority of the contracts with government procurement regulations, and that has been subject to that. Other than that, what we can say is that this review is specific to some historical purchasing procedures that the company had in the past, and we cannot comment really much more than that in terms of facts, because that entity, again, is separate, is independent, has its own body, and is subject every year to the review from the Ofgem. So, Adolfo, probably on the bigger context, you can add more color once you come off mute.
No, I mean, listen, there is everything that Pablo said is absolutely true. It's an audited entity. The vast majority of what we procure on behalf of the license, we DCC procures, is audited, and is actually done using the government procurement guidelines. The cost allowance and cost disallowance is part of the regime, and there is very little more to that. The surprise, right? The surprise of why somebody taxes crossed in something that doesn't have anything to do with us, without prior engagement, without prior. So, we all found out at the same time. And I have written to Ofgem to demand an explanation as to why they've never had to do this. They've never done this. This is no form. There is no precedent in them handling the communication this way. And then there is very little more that we can say. So in an ideal world, we would have just said a lot more, but there isn't a lot more to say. But they created this uncertainty, and they created the uncertainty like 6 working days or 7 working days before we came out with the results. So we took advice. Is there anything that we could or should say? And it was deemed that it wasn't on the right thing, given that it is what it is, that people, there wasn't any more that we could say beyond what you just heard now, and that doesn't warrant an RNS. And that was advice from brokers and lawyers and everybody. So we went along with the advice. Upsets me as it upsets you that the value of the share went down, but ultimately nothing has fundamentally changed. What we're doing as a management team, working here with DCC, with Ofgem, but with everything else that we're doing, hasn't really changed. Somebody compare this to cyber incident. I think it's very different. I think that's probably a light comparison and maybe not all that factual. And this thing came about, and sometimes it's hard to react to everything real time using a regulatory news service. So we're not concerned beyond that this is part of a normal process. Has been. We don't have any visibility to the contrary. And yeah, I'm expecting to have my meeting with Ofgem soon to understand how this was possible.
Okay, thank you. Next question here. In July, it was announced that the UK government had signed a deal with OpenAI to increase productivity in the UK's public services. To what extent does that impact on Capita's own AI ambitions in the sector?
Yeah, it's a really, really good question. I mean, I don't know whether we have the ability to share screen again, Barney, but if you can, that would be great to put slide 28 of the deck. If it's not possible, forget about it, but it would just make the answering of the question a lot easier. Yeah, 28. Getting that. Yep, the one before. Thank you. So yeah, so July, yes, we saw the announcement, the government and OpenAI. Before that, we saw the announcement between the government and Microsoft. We have also seen engagement and big investments by ServiceNow in the UK. This is going to be a regular feature, or whether it's going to be an announcement one after the other. What is really important for us, we've seen Palantir and a number of them. Recently, we saw AWS also talking about building more infrastructure and services on UK soil to help with a number of solutions, particularly also sovereign. So, but to me, it's brilliant because everything that's been done in this chart below the line, right, of applications that you see there is stuff that we can leverage, right? We are not going to be replacing people. That would be silly, right? If I ever say we're going to replace any of the people below the line, that would be totally wrong. Our ambition is to map all the great things that people are doing below the line, so the more the better, map that to the customer business processes that we manage, and figuring out what innovations are going to be helping what business process and what is the best available agent or tool that we can use. That's going to be mission number one. Mission number two is we need to recruit, develop, train, manage all the skills associated with operating this tech. This is something that we've been doing for decades and we do really well. The third thing is there is the governance, right? How do you deliver the governance? What data are these tools allowed to use? What events are they allowed to log? For what purpose, right? What data it's grounded? What are the permissions? What's the human? What's done by the machine? So there is a governance framework, which we do today on everything that we do. So we have just extended that framework to also now looks after the AI at play. And then ultimately it's just to deliver everything as a managed outcome. So every time I see something happening of that value chain with our large markets, like in this particular case, the public sector, that is new news to me because it means that the government really is going to have to use this, but ultimately they need help with skills, they need help with the data, they need help with the mapping, and they need ultimately the business process expertise where these tools are supposed to work. And that's what Capita is uniquely placed to address.
Great, thank you, Adolfo. And I think we've got time for one last question here. Here it is. With the 55 million in one-off restructuring cash costs set to be fully absorbed by the end of this year, this seems to create a significant built-in structural tailwind for your 2026 free cash flow baseline. Could you elaborate on how the completion of this investment not only de-risks the business, but also provides a powerful springboard for achieving sustainable cash generation next year?
Yeah, I mean, it's absolutely right. I mean, we're doing three things at the same time, right? We are getting rid of overhead that we didn't need in different parts of the business. And, it's maybe traditional SG&A, but there were also areas where we could do things better. And that is good. We needed it. We were running the machine on too much cost. Thing number one, that's the risk. And the second thing that we're doing is we're reinvesting the 50 million into the growth engine, right? So you're hearing how we position the company probably better than many of our competitors for this new wave of growth, how we're making it real, how we are retuning the go-to-market model so that we can improve win rates, so that we can go and improve the TCV value, the book. So all of these things are actually about growth. And the other thing that we are doing is fixing the basics in the process, right? As I said, taking cost out is relatively easy, but taking the cost out while fixing the basics so that it doesn't come back is really good. But as you do that, you get some other benefits. So, for example, order processing at the moment in this company to this date is highly manual, right? That is not a good way to ensure that we get to the best solution. So as we deploy our EOS platform by the end of the year, we're going to be able to move more and more of our businesses onto automated, intelligent AI-powered order processing. The benefits from fixing those basics, right, will be felt in 26 and it will be felt in 27, not only through cost containment, but business agility, revenue leakage prevention, etc., etc. So, to the question that just was asked, I think getting that done is going to give us a much stronger business. It's also going to be a lighter business. So, from a free cash flow generation perspective, we're going to have a lot more tailwind in 2026, which is why it's so important to get all of these things done in the second half of 25.
Great. Thank you, Adolfo. Thank you, Pablo, for presenting so clearly and answering as many questions as we could do. And I apologize, we didn't get through them all, but we tried to catch as many as we can. You'll be exiting in a minute. And as you do, there'll be a survey that we'd ask you to complete. It'd be really appreciated if you just spend a couple of minutes completing that. And just before they do exit, could I just hand back to you, Adolfo, a second, just to say a couple of concluding remarks?
Thank you. So the first thing I'll do, I think we should get back with an answer to these questions that were asked and we didn't get a chance to cover. So Alex will work with you to get you the answers. I think it's important that every question gets answered. The second thing, I think a lot of people have very long memories as to where Capita used to be. Understandable, totally understandable. I remember the Capita I inherited 18 months ago. But I am more focused on the Capita that we're trying to build going forward to take advantage of the opportunities. And I believe we're well underway. We're not done everywhere, but you can already see areas where we are significantly ahead. And we will continue to do this, right? We continue to create the space, fix the basics, and invest in the future. Going into 2026 with a much stronger business, free cash flow generative business, and one that will be relevant and winning in the new growth areas. It's a really exciting place to be. And as hard as it is to have this job, it's a really, really exciting job to have. So thanks for everybody's support and interest. And I guess I'll meet you on the next of these events in the next few months.
As I said, thank you, Adolfo. Thank you, Pablo. Thank you for our audience for coming along. And as you exit today, please could you just spend a couple of moments completing that survey form. Thank you now and goodbye.